Hello everyone, this is Mohammed Kurbatli again. I have an MBA from the USA and I received my CMA designation in 2012. I'm making these videos to help you prepare for the CMA program, that's Certified Management Accountant. In my first video, I overviewed the CMA test in general. In this video, I'll start overviewing CMA Part 1. Like I said in the first video, CMA Part 1 covers topics from financial accounting and management accounting. So let's spend a few minutes talking about the differences between financial accounting and management accounting, and then in this second video I'll talk about the topics of financial accounting, and in my third video I'm going to overview the topics from management accounting. Okay, so financial accounting and management accounting provide financial reports. So what are the differences? Well, financial accounting reports are legally required. You have to present these reports to investors if your company is listed on a stock exchange, and you have to present them to government agencies. So that's a main point. Financial accounting reports are required by law, and they are directed to external users of financial statements. Actually, even if you didn't have to provide these reports, you will probably provide them to your investors and prospective investors to attract and creditors to attract them to provide funds for your company. Management accounting reports are not required by any external parties, but they are needed for internal decision making to support management as it does its job. Managers do planning, organizing, directing, and controlling, and all of these aspects of a manager's job require quantitative financial elements to them. Okay, so again, financial accounting provides information to external users, while management accounting provides information to internal users. Financial accounting information is focused on the historical performance of the firm and its current financial position. So the information produced is historical and current. Management accounting covers historical and current information, but it also cares about the future. Again, you need to do planning, and part of planning is budgeting. So you're going to forecast your performance and look into the future. Okay, now since financial accounting information is actually a bit more formal, right? Actually, it's much more formal, right? Because it has to be sent to tax authorities and stock market regulators and so on. So it has to follow standards. And indeed, there are such standards. In the US, there's GAAP, and internationally, there's IFRS. Whereas the criteria that govern the preparation of management accounting information is the relevance and usefulness of this information. Its relevance to the decision making, and it has to be presented in a way that makes it useful for decision making. Okay, the criteria here is that all material amounts must be disclosed, whereas here we actually focused on how reasonable we can estimate numbers to make decisions. Okay, again, because here there's a legal requirement, whereas here we're trying to make decisions as efficiently, conveniently, and as practically as possible. Most of the information of financial accounting is high level and focuses on the company as a whole, whereas management accounting information is can be quite detailed. There's no fear here of disclosing any sensitive information to competitors and so on. So we really present all the information. Okay, so next we're going to talk about the topics from financial accounting that are covered in CMA Part 1. Okay, now first of all, I'm going to do a review of the accounting systems and the accounting process. Now, this is not exactly part of the CMA Part 1, but it's required information, and therefore, just because I'm a good guy, I'm going to go over it for you. We're going to talk about accounting standards, why they're needed and what they are. We're going to talk about the different financial statements in detail. Not the same level of, much more than the level of detail you have in a basic financial accounting course. So we'll really dig into these statements, including the income statement, the balance sheet, the statement of changes in owner's equity, and the statement of cash flows. And finally, we're going to talk about revenue recognition standards, because this is a big issue and it has been causing trouble as some companies have been aggressively recognizing revenue or manipulating their revenues. So actually this is a high level view of the topics, of the financial accounting topics we cover in CMA Part 1. Okay, so first I give an overview of accounting systems, right? How these systems capture financial events and process them to produce financial reports, including financial statements and other disclosures. I'm going to remind you of the accounting equation: assets equals liabilities plus owner's equity, and the different elements of assets, liabilities, and owner's equity. Then I'm going to present some basic financial transactions and show you how they can be analyzed in terms of their impact on the elements of assets, liabilities, and owner's equity. Next, I'm going to talk about how these transactions are journalized, and that is recorded in the general journal or special journals, and then how they are posted to the general ledger and subsidiary ledgers. Then I'm going to talk about end of period adjustments, including accruals and deferrals of expenses and revenues, and then the preparation of the financial statements and the closing of the accounts. Okay, so here we're going to have a review of the basic steps of the accounting function. Next, I'm going to talk about accounting standards, why they are needed, and what they are. In the US, there's GAAP. We're going to talk about that. That's generally accepted accounting principles. I'm going to talk about the set of standards and the role of different organizations, including the Securities and Exchange Commission, the FASB, that's the Federal Accounting Standards Board, and the AICPA, or the American Institute of Certified Public Accountants. We're going to talk about these organizations' role in the production of American Accounting Standards, or GAAP. And then I'm going to talk about IFRS, International Financial Reporting Standards. These are standards that are being used by many countries around the world, and they are recognized and required in the European Union. And I'm going to talk about the role of the International Accounting Standards Board in their creation. And then I'm going to talk about how the FASB and the IASB are working together to converge these two sets of standards to basically make them compatible with each other. I'll do that actually right after I talk about the similarities and differences between these two sets of standards. Next, I'm going to talk about the income statement in a lot of detail. We're going to talk about the usefulness of the income statement, what kind of information is present in it, and how it can help decision making by external parties like investors and prospective investors. I'm going also to talk about the limitations of the income statement. These are issues that the readers of the income statement must keep in mind as they read the income statement and make decisions based on it. Then I'm going to present a formal definition of revenues, expenses, gains, and losses, and give examples of these. Now again, these are the basic elements of the financial statement. Next, I'm going to talk about two possible ways of presenting the income statement, including the single-step method and the multiple-step income statement. And then I'm going to go into the details of the income statement. Here's a multiple-step income statement, and these are the points that we're going to cover about it. We're going to discuss the details of the operating section, the non-operating section, which includes a lot of gains and losses, income tax, excuse me, income from continuing operations, and then we're going to talk about special items, basically special gains and losses, including gains and losses from discontinued operations that must be separated from continuing operations. So readers of the income statement know that these items are not going to show up again in the future. We're going to talk about so-called extraordinary items. These are items that are both unusual and infrequent and therefore are separated from the other items on the income statement. I'm going to talk about non-controlling interest, and this is the share of the income of a consolidated entity that belong to minority shareholders. Now, don't worry so much about this. I'm going to cover it in detail, and I'll make it really easy to understand. And we're going to talk about other comprehensive income. Again, these are gains and very special gains and losses that are separated even from the net income because of their special nature. Then I'm going to talk about EPS, earnings per share, another required disclosure for the income statement and how it's calculated. And I'm going to talk about how companies must account for changes in accounting principles, changes in accounting estimates, and accounting errors. Okay, after that, we cover the balance sheet in detail. We'll talk about the usefulness and limitations of the balance sheet, and we will talk about all the items, all the major items that appear on a typical balance sheet, and we will cover these in detail, much more than you would see them in a basic financial accounting course. So yes, we're going to cover all of these items in a lot of detail. Okay, next we talk about the statement of changes in owner's equity or stockholders' equity. We'll talk about its usefulness and its elements and presentation. Okay, why is it needed? What unique perspective does it offer? Next, we're going to talk about the statement of cash flows. This is an extremely important statement, and we're going to cover it in detail. We're going to see how it's divided into three main parts: cash flows from operating activities, cash flows from investing activities, and cash flows from financing activities. And we'll see two different methods of preparing it: the direct method and the indirect method, which mainly impact the way cash flows from operating activities is presented or are presented. Finally, I'm going to talk about revenue recognition. This is a big deal. It's a contentious part of the standards of financial accounting. We'll see the general rule of revenue recognition. That is, revenues are recognized when they are realized or realizable and earned. We will see what that exactly means and how it affects recognition of different kinds of revenues. We will see how this rule can result in recognition of some revenues before delivery of the goods, right after the delivery of the goods, or at the point of delivery, and later on as cash is collected or a real sale takes place and collectability can be estimated more accurately. Okay, so we're going to cover things like the percent of completion method for long-term contracts, completion of production basis, right? In these two cases, we can actually recognize revenue as we work on the project or right after we complete production of certain types of products. We're going to see that we mainly recognize revenue at delivery in normal sales arrangements and in the completed contract method. And finally, we will see when revenue recognition must be delayed until after delivery. Again, we'll spend a lot of time on revenue recognition standards because companies have been manipulating revenue and earnings in general, and we need to discuss how they might do that. Okay, so that's it for this video. In my next video, I will talk about the topics of management accounting that are covered in CMA Part 1. I'll just give an overview of them, and then we will go back to the beginning of all of this and go into the details of CMA Part 1. Thank you very much.